back to our channel. Today's video is the one I promised you earlier this week, going over and digesting all of the economic numbers that were released this week and talking about how they are going to relate to the real estate market in general. And remember, if you find this info helpful, please subscribe to our channel so you never miss a video. And if you want to see more from us, follow us on social media so you can be the first to know about videos that we have coming out. All of the links will be in the description. Thanks a lot. All right, guys, let's dive into these numbers. So, as I expected, the GDP number came out and it was down 0.9%, which was worse than expected. That also means it's a second quarter in a row of negative GDP, which was a little bit better than the 1.6% we were down in Q1. But the definition of a recession has long been held as 2 consecutive quarters of negative GDP. And I knew the administration was probably going to try to get this number to look as good as possible. And, I suspect that they did, getting it to the negative 0.9%. I didn't suspect that they were going to try to change the definition of a recession. So if you've been watching any mainstream media or any media lately, you've probably heard the words "we're transitioning," or "no, this is not a recession because the job numbers are still good." And while I do believe that there is something to be said for the job numbers being good and the job market being strong, I also believe a lot of that is because people have dropped out of the job market altogether, and there are several people that have multiple jobs just because they're trying to keep up with inflation and their wages have not done that. So, what other numbers came out this week in addition to GDP? We also had consumer confidence numbers came out. They were down for the third straight month, and they are down to the lowest level we've seen in over a year and a half, which is not a great indicator for the future on where the consumer thinks things are going. We also had, lastly, the Fed meeting. The Fed raised the rate by 0.75 point. As expected, I thought there was a slight chance we might see a bold 1-point move, but then the numbers that were coming out earlier in the week, it kind of looked like it was probably going to be the 0.75 point move, and that's what they did. They also said that there will be future moves before the end of the year. We'll probably see a 0.25 point move at the next meeting in September, and I'm a little bit iffy if we're going to do that last move in December. I think there's a good chance that the moves that they've made so far will slow the economy enough. By then, all the numbers will catch up, and we'll see a slow enough economy that they might not have to do that last move. So stay tuned for what happens on that. But as of right now, 0.75 point move. Now, how does that 0.75 move affect you? Well, if you have an adjustable rate mortgage, or you have a credit card or auto loans, those are all going up. The good news, though, is mortgage rates dipped Thursday and Friday. So we saw a drop to closer to 5% on mortgages from about 5 and we're about 5 1/8 actually right now, and we were around between 5.25 and 5.5. So we saw a decent drop in the mortgage rates, and this was because there was a flight to safety in the bond market, which drove the yields down. Now, speaking of yields, we talked a little bit earlier this week about the inverted yield curve. What this means is that the 2-year Treasury yield is giving a higher yield than what the 10-year is. This is another classic indicator that we are in or about to be in a recession. So you put that together with the 2 consecutive quarters of negative GDP, in my mind, that's a recession. I don't really care if we're transitioning or however they want to try to change the definition. That doesn't matter to me. In my mind, we're seeing a recession now. So let's talk about real estate numbers. So all of these factors are lagging indicators on what's going on. So if you look at closed sales in the real estate market, that's something that already happened. So what I like to look at to give you the most up-to-date information and kind of tell you where things are going, not just where they were, is active listings and pending listings. That's ones that are in escrow. So these 2 indicators will kind of tell you where the market's going and what kind of market we're in right now. The 2 indicators are not great news for the real estate market. Great news if you're a buyer, because prices are going to come down. It's going to happen. I still don't think we're going to see some massive drop like we did in 2008. Keep in mind, the recession that I believe that we're in right now is because of inflation. The one from 2008 was because of real estate. Real estate lending guidelines were way too loose back then. Anybody could get a loan. They tightened them up after that. So this recession is going to look a little bit different. We are not going to avoid prices coming down in the real estate market, though. It's not going to happen. We've seen too much of a run up over the last 2 years. In 28 years of doing this, my best years for income were 2020 and 2021, which is amazing to me considering we had, COVID and everything that was going on, and yet prices went up so much and sales were so strong that it produced my 2 best years. So, and that's the same for a lot of people. Looking at where the market is in the Conejo Valley, so I'm going to go a little bit local here and dive in a little bit local, and also look at some nationwide numbers as well for those of you that are kind of wondering what's going on throughout the nation, because when you listen to the news, the numbers that they give you there are usually the nationwide numbers. It's going to skew the picture a little bit from depending on where you are. So right now in the Conejo Valley, we are looking at 228 active listings. This is up from May. That was in June, I'm sorry. That was the June number, which was up from May at 168, which was up from April at 132. So that move from May to June was a 36% increase in inventory. The reason this has been important is because a lot of the gains that we've seen over the last 2-3 years in real estate have been because of super tight inventory. There just hasn't been a lot of homes to sell. So buyers were driving the prices up, bidding against each other. As we see more inventory and demand leveling, you're gonna have to see prices come down to compensate for it. So a 36% increase from May to June in active inventory is a pretty good sized jump. If we look at the pendings, these are the ones that are in escrow. So Conejo Valley, April, 87 in escrow. May, 88 in escrow. June, 56. You see that big drop off, and I suspect that July we're gonna see an even bigger drop off in pendings. So that drop off is gonna show up in closed units and prices a month or 2 from now. Our absorption rate has gone up from 0.75 in April to 1.43 in June. The absorption rate is the number of months of inventory that we have available. So if no new inventory came on the market, in April it would have taken 3 weeks for everything to sell. In June, it's gonna take almost a month and a half. So that's a pretty good sized jump in absorption rate. Once again, this shows increasing inventory, increasing supply, demand level, you're gonna see a drop in prices to make up for that. So, which is why, like I said, the mortgage rates dipped a little bit. So for the San Fernando Valley, somewhat similar numbers. Actives in the San Fernando Valley in April, 314. In May, 384. Actually saw not too big of a jump there, but then in June it jumped to 503, which is a 31% increase. Pendings, somewhat similar. 98 in April, 119 in May, 96 in June. So that jump up in May was a little surprising, but then you see it drop back down to 96, and I guarantee you July is going to be even lower. Absorption rate in the San Fernando Valley increased as well from 1.06 months worth of inventory in April to 1.88 in June. These numbers are probably going to continue to increase. Now, once we get to an absorption rate of closer to 3, 4, that's when we're going to see a real inflection point, a real move in prices, if it gets that high, because that means we have 3 or 4 months of inventory. But keep in mind, guys, don't freak out. The sellers, don't freak out. These are not reason to panic. We're basically going back to pre-pandemic numbers. There was a time when you listed a house and it sat on the market for 30 to 90 days before it sold. I know it's hard to believe. We're so used to 30 to 90 minutes over the last 2 years, but no, we're gonna go back to a more normalized market where we're looking at lead times of 30 to 90 days for properties to sell. And as long as you're not freaking out and you're not panicking, you'll still be able to get good prices for your homes. Now, like I said, I do feel that prices are going to come down in our area somewhere in the 10 to 20% range from where the peak was. Now, the peak, we've already passed it. We've already started to come down. So the peak was probably in January or February of this year, which is what I was saying in November and December of last year. I was telling my clients, we're gonna see a peak pretty soon here. And sure enough, it was probably in January or February, because that's when rates really started to jump up. For the beginning of the year, you could get a rate under 3%. Now you're close to over 5%. So that's that big move is what's really affecting the demand. So let's look at some even bigger numbers, and then we'll go out even a little further. So for the San Fernando Valley, year over year comparison, for July, for the third week of July, total active listings are up 4% from last year. Pending sales down. These numbers are straight from the Board of Realtors, for San Fernando Valley Board of Realtors. Pending sales down 39.4%. Closed escrows down 33.8%. Year-to-date closed escrows down 21.7%. I'm going to show you a couple of charts here. First one is total active listings, and you'll see it's looking like this. It's going up. Inventory is rising. Show you another one here, which is the single family median price. It's coming down. It's, like I said, inevitable. When you have more inventory and demand is not increasing, you're gonna see prices have to fall a little bit. For my sellers, it's hard to stomach, it's hard to get, but keep in mind, the gains that you got from beginning of January or beginning of 2020 till now, or till the beginning of 2022, we saw some massive gains in there, 20, 30% increases in price. So if you give back 20%, you're just going back to pre-pandemic pricing, which is not the end of the world for a lot of us, because we've probably put more down on our properties. It's not like it was in 2008 where nobody was putting anything down. We're seeing more 20% downs. You built up a lot of equity. If you bought in the last 4 years, you've built up a lot of equity. So if you have to give a little bit of it back for now, as long as you don't sell, you didn't lose it. All this being said, guys, I'm still a long-term believer in real estate. And if you're planning on staying in the property for 5 years or more from now, you're gonna be okay. We're gonna see prices come back up. We'll see rates dip back down. Now, I firmly believe that the rates of 2.75, under 3%, you won't see that again. I've been doing this for almost 30 years, and over the last 10 years we've seen those rates, but it's not normal. If you look at the last 30 years, the average rate is closer to 6%. When I bought my first place in 1998, my rate was 6.9%, and I was thrilled that I was under 7%. When I bought my house in Woodland Hills, the rate was, I think my rate was 5.5 on that one. So, and that was a great rate at the time too. So obviously I would, for my buyers, I'd love to see these 2.75 rates, but it's not a realistic number. They kept the rates artificially low for far too long, and that's one of the reasons we're in the mess that we're in now with all this inflation, is that there was just too much cheap money out there. And then with the pandemic, they flooded it with even more, with all the stimulus money. And unfortunately, looks like they're voting on another bill or next week to pump another, I think it's around $380 billion or something like that into the market, via stimulus, and that was just voted on and sent to the House. Manchin finally caved in, and they're sending that. So we'll see what happens with that. I don't understand why we can't figure out that if you print more money and you shove more money into the markets, it's going to cause inflation. But hey, I'm not running the joint, so I guess we'll see what happens there. Nationwide numbers, there's gonna be some skewing. There's certain areas that are gonna get hit harder than others. I believe these areas are gonna be kind of the Phoenix area, Vegas probably, Boise, Idaho area. I really think these areas where they've seen a lot of inflection, a lot of movement from people coming from California, maybe some parts of Florida, people cashing out in California, moving to these areas and driving their prices up. When that demand is not there, I think those areas are going to get hit a little bit harder than maybe some of the areas in our local area are going to get hit. So when you look at the nationwide numbers, you might see some numbers that sound scary, but please feel free to reach out to me, and I'll talk to you specifically about your particular area, because those numbers might scare you more than they need to. All that being said, if you're thinking about selling, do it now. Don't wait for these numbers to come out, because once they hit the closed numbers and we see these prices come down, you're gonna see a little bit of a hit. If you're thinking about buying, it's never the wrong time to buy the right deal. Keep that in mind. But if you're telling me I'm gonna move in 18 to 24 months, I probably would hold off, or I'd rent. If you're saying you're gonna stay for 10 years, let us find you the right deal, and you're gonna be okay. Thanks a lot for listening, and if you, like I said, please comment down below. Hope you found all this information helpful. If there's something specific you want to know about buying, selling, or investing in real estate, please either hit me up in the comments or reach out to me via all my social media, which you can get in all the links to in the description. Follow us to stay up to date and what we're doing around the LA area. And as always, please subscribe to our channel. We never want you to miss a video. Thanks for watching. Have a great day.